Welcome to the Capital Exchange. I'm Steve Wilbur, Managing Director at Allen Capital Group.
And I'm Travis Portwood, Chief Investment Officer with Allen Capital Group.
Travis, we've always said that over the long term, stocks generally track their fundamentals like sales growth, earnings growth, etc. But over the short term, prices fluctuate based on market sentiment, both good and bad. One form of market sentiment not often discussed, maybe it should be, is inclusion or exclusion from certain indices.
Yes, Steve, and that sentiment we call force buying or force selling. For example, there is about $7 trillion tracking the S&P 500 via products like mutual funds or exchange-traded funds, ETFs. And when a company is added to the S&P 500, all of the funds tracking the index, all 7 trillion, regardless of anyone's fundamental view, have no choice but to buy that stock. And all of that forced buying usually does what? Drives up the price of that stock.
Right, Travis. We saw this with Uber this week. It was recently added to the S&P 500. The stock price jumped. But I think it's important to remember that this works in the opposite way as well. If a stock has dropped from the S&P 500, the same $7 trillion in products tracking the index must sell, driving the price of that stock down typically.
Very true, Steve. And some might see opportunity in those sell-offs, and some might say, hey, it's justified. The stock no longer qualifies to be included in the S&P 500. But I think the lesson for investors here is know what you own. Since 1995, there have been 700 changes to the S&P 500 index.
Wow.
So in other words, the entire index has turned over more than once since the Clinton administration, for those who remember the Clinton administration.
Yeah,
so,
I think we do.
So remember, owning the S&P owning the S&P 500 means you get a piece of every good, every bad, or every indifferent company currently coursing through the market.
So true, Travis. It's been great. I look forward to it next week.
Look forward to it as well.